What is happening, investors? It is your boy Jack, and today we are going to be speaking about 5 stocks that are all down 50+% in recent times. And are any of them a good buy right now, baby? First of all, I want to say, long time no see. I hope you are all doing good. Me personally, I'm doing better, man. I'm finally starting to keep up with the stock market game again. I'm finally starting to look out for some deals, some things to buy. I'm finally starting to keep up with, macroeconomics again, the way that the world is going, etc., etc. And most importantly, I'm enjoying it, baby. I can actually happily enough sit down and start looking at these things. So here is hoping that we are going to be back to regular uploads, baby. Here's hoping that we're going to be back to looking at juicy stocks and bringing you guys some juicy videos, such as the one we have today. There is going to be a bit of a layout for today's video, so we're going to be going through each stock one by one. We're going to be, first of all, looking at the stock's chart, see any abnormalities, any interesting price ranges, show that we are down 50% from the highs. We're going to speak about if we want to buy them now, if we want to wait a while, what the trends are showing us overall. Okay, we're going to be seeing what are the analysts saying, because obviously the analysts know a lot more than the majority of us watching these videos, the majority of the time at the very least. We're going to take a look at the balance sheets. Obviously, right now, with the way that the world is going, there's a lot of concerns surrounding, are any companies ultimately going to have to go, take out some really bad loans, give some really bad rates, and worst case scenario, go all the way down to the ground and your investment turns to zero. So we're going to be taking a look at the balance sheets. We will take a look at some important things from each company's most recent quarterly report, and just a couple of pieces of news that should influence our decision to buy or short or sell or stay away from the company altogether. So the very first company we're going to be speaking about today is one called Meta, okay? A company I have owned for quite a while. A company that, generally is seen as one that just goes up. Very rarely will there be any huge pullbacks. The last one we see is the March 2020 crash, where, everything crashed to this kind of extent. But then it went on an insane rally. For Meta, going from $137 a share all the way up to peaking at $386 in the span of less than 2 years is absolutely insane. Quite obviously. There's no other way of putting it. For a company such as Meta, as big as they are, that is not normal. And now they are sitting pretty at right around $169 a share, again from those highs of $386. Now, I don't think the majority of people need me to tell you why Meta is generally perceived as a good investment, a good, safe, long-term investment. And it's important to keep in mind that with every company we're going to speak about today, we're looking at it with a long-term perspective. Okay, we're not trying to guess if it's going to come down a further 10-15%. We might speculate, we might speak about it, but we're not looking to trade this. We're not looking to take it up to 200. We're not making a quick 10-20%. We're speaking about stocks that we can hold in our portfolios for the next 5 years, 3 years, whatever it is, a considerable period of time, looking for some big gainers. Okay, so Meta is the first one to make that list, down I believe about 55% from the highs. What is Wall Street saying? As of right now, 55 analysts covering it in the last 90 days. 32 of those are at strong buys, 8 buys, 14 holds, and only 1 sell rating out of every single one of those analysts. So it's quite clear to see that, the general Wall Street consensus is to buy Meta as of this moment in time. Now, does that mean that it can't go down lower? No, it most certainly can. I mean, it most certainly could drop 10% in the next 2 days, in my opinion. I'm not saying it's time to go absolutely all in on Meta, but when we look at the chart, okay, RSI is lower than it historically is, implying that it's considerably oversold, okay? It's quite clear to see that when we look at this chart. Facebook pretty much has never seen a 50% drop since it's been a very, very large company. But with that being said, it most certainly can go down lower. So just do keep that in mind. It's just one to have on the watch list. It's one that if you buy, buy a little bit here and there. Me personally, I haven't been buying anything over the last long number of months because of the way the market is going, and I'm better off for it. But a lot of things are getting to stages now where I could consider throwing some money in. And also, there's a few things we're going to cover towards the end of this video in regards to bank stress testing, what the banks are saying in general for the next week, for the next month, recession, etc., etc. You guys know the gist. But anyway, that's what Wall Street is saying. And if we look at the balance sheet, I mean, this has always been a thing about Meta, or Facebook before it even was Meta. Their balance sheet has always been one of the most beautiful in the entire world. If we just look at the ratios they have when it comes to total current assets, sitting here at 59, total assets at 164, okay? Current liabilities at 21. I mean, their cash and short-term investments cover their current liabilities 2 times over. Very rare to see that for a company anywhere near as large as Meta. And it only gets better when you look at their total liabilities. They could clear their total liabilities tomorrow just with their cash and short-term investments. I mean, yeah, they're in a very, very, very good cash position. We will put it that way, simply put. So that's obviously why, it's one of the most pushed stocks in the world of Wall Street. It's in the large majority of any large institutional's portfolio. So just, that's Meta. When we go ahead and take a look at their first quarter 2022 results, quite a few things happened and quite a few bad things happened. This dip here you'll see was due to some terrible earnings the quarter prior to this, okay? And that's why, I want to stress the fact that it's not time ever really to go all in on any one stock. But Meta is definitely no different. And as I said previously, they could easily, and I mean very easily, drop down considerably lower, okay? If we do take a look at this quarterly report, we'll see why. Total revenue, year-over-year change, is up 7%. Income from operations is down 25%, okay? So, obviously, people are going to see that fact. It's not a great thing, largely due to the fact that costs and expenses went up 31% year-over-year. But if we do go ahead and have a look at some of what they call their operational and financial highlights. Family daily active people, 6% up year over year. Family monthly active, the exact same, 6% year over year. Daily active users up 4% year over year. So we still can see that, Facebook very, very much so is growing through their transition into the metaverse, which is ultimately Mark Zuckerberg's, new vision for this company. Ad impressions and price per ad. This is a relatively important one because we're also going to speak about something in relation to this soon. First quarter 2022, ad impression delivered across our family of apps increased by 15% year over year, and the average price per ad decreased by 8% year over year. So it is important to be keeping that fact in mind, okay? We obviously want to see this number go back up a little bit, okay? One thing I want to point out, just while we're on the topic of ads, Facebook and Instagram won't take a cut from creators' revenues until 2024. So right now, right off the bat, you might think, well, that doesn't sound great for us investors. We obviously want to see them taking that money in. Me personally, I think this is a very smart decision. Look at TikTok right now and even look at YouTube. I mean, these companies make so much money from their creators. Facebook and Instagram need to give those users a reason to put more time into their platforms, okay? They need to be competitive. They are not at the top of the game right now. I think this will pay off in the long term. If this does, entice some people to spend more time and effort on these particular platforms, it's going to, lead to a lot more revenue for Meta, for Facebook, etc. down the line. So, short term, obviously, we'd rather this money going into Facebook's balance sheet, etc. But long game, do we really need it? No, we just saw that their cash and short-term investments cover all of their liabilities as of this moment in time. I think this will be better overall for the platforms with a 2, 3, 4, 5+ year outlook. There's already so much pain going on anyway. If they started taking these cuts from creators, what reason do they have to come to Facebook and Instagram? It's not where a lot of people are taking this kind of content from just yet. Just the first thing from the CFO outlook, we expect second quarter 2022 total revenue to be in the range of 28 to 30 billion, okay? So similar enough to what we just had, which again is not great. And Facebook is not in a growing period right now. That's why it has to be kept in mind. And that's why, you don't go throwing your whole life savings there. It's more than likely we're going to see some pullbacks. And again, it's important to remember that now you're not really just investing in Facebook as people were for the longest time. It is having this entire shift over to Meta. This article here, Mark Zuckerberg lays out the future of Meta. You can go read into it as much as you want, but in a virtual roundtable with reporters last week, 2 weeks ago now, Zuckerberg acknowledged it will take years for compact headsets to display photorealistic images. Still, Meta is making progress towards that goal. So again, there really, really is a long-term outlook here. More than there was so in 2020 when we were just investing in Facebook, in Instagram, in WhatsApp, and their other small businesses. In, the manager takeovers they've often done down the line, in the incredible balance sheet. You have to be willing to look forward into what the future of Meta is, not just Facebook. But anyway, guys, that is the first company of today. Now, the second one may surprise people. It is a company I own. It is Neo, but it's also one that, I was very opposed to buying for the longest period of time when we were up at these prices in the 30s, 40s, 50s, etc. A lot of it came down to this here when JPM upped their price target and then ultimately started bringing it back down. They've cleared out all of that liquidity. They've profited their shorts, and now, they may well be getting ready to buy again. We can kind of see that right here. We can see that, they came out, took out all of this liquidity, tested all this, tested that low, And now they've started to come back up into some relatively interesting ranges that we have had mapped out literally since, oh, I don't know, late 2020, a long time ago. But again, we're investing in the company. So why do we believe that, NEO is going to do quite well going forwards? Okay, well, one thing I just like to point out really quickly is NEO Institutional Holdings. Its institutional ownership is at about 35%. And we have kind of seen some people getting in and some people getting out. Some people increasing positions in NEO, some people decreasing them. I just like to point out that some of the people increasing their positions in them over the last quarter. We have BlackRock, Vanguard, Goldman Sachs, and Morgan Stanley at the top of that list, putting the most money into NEO out of any other institutional investors. 4 of the biggest that are out there. Now, there are some people decreasing it. I don't want to go away from that fact, but nobody really near as big. We do see Deutsche Bank there. We see some JP Morgan, but not to the same extent that these guys are putting money into NEO. So overall, we see big institutions flowing into NEO as opposed to coming out of them. And again, this JPM, a lot of that would have just been closing the positions that they had set beforehand before they changed price targets to bring NEO stock ultimately lower down the line. So we go ahead, we look at the chart, we can see, it's in a period of consolidation quite clearly around these very prominent areas we've had marked out for a while. Again, I want to point out that NEO is still high risk in my personal opinion. I think most EV companies are, even Tesla, any of them realistically. And you have to be extraordinarily careful when buying into these companies in any way heavily because of the risk factors that come with them. So again, this isn't me saying, it's time to load the boat on NEO. Do I think that in 3, 4, 5 years' time we are above all-time highs? Yes, most certainly. But that is just me. So again, we take a look at Wall Street's ratings. 15 strong buys, 7 buys, 2 holds, and no sells. Now, this is just 24 analysts covering NEO. But still, that is considerable. That the 24 analysts that we do have here all looking to buy. Now, obviously, this balance sheet looks nothing comparable to the Facebook one that we just had a look at. And again, that adds yet again to the risk factor. Let me just take our latest to the right. Where are we? Latest to the left. Sorry, I'm just going to fix this quickly. It's easier to read. You can see that the growth has been absolutely insane. Truly insane. The growth from these guys has been nuts. If you were one of the people who started buying in with us in mid-2020, you're still doing well, despite all of the loss that has been suffered since the highs. If you're one of the people who started buying in, back down around these general areas, the 7, 8s, 9s, 10s, you're still doing very well with your NEO stock. So, cash and short-term investments, we're at 7. Where we go down to our total current assets, we are at 10, just to make things easy. And you see, we don't have too many more than our current assets right here. Current liabilities are at 5, so again, they can cover their current liabilities quite easily. Total liabilities at 7.8. It is not the worst balance sheet in the world by any means whatsoever, especially if you are looking for a very high growth EV related stock right now. NEO is truly one of the leaders at this stage, particularly in China. They do have a lot more to take over, but the growth speaks for itself. It truly has been incredible as of right now. NEO had a really good run last week because of this. Alibaba and NEO stocks soar after report that Ant Group are okay to set up a financial holding company. So the US listed shares of these China-based companies saw big and broad gains in pre-market trading Friday after Reuters reported that China's central bank accepted Ant Group's application to set up a financial holding company. So again, maybe NEO is going to be able to bring back a little bit of strength. We will see relatively soon what happens here in regards to institutional investors. We should get an update literally the start of next month, if not the end of this one. We take a look at key operating results just really quickly. Deliveries, they've been somewhat stagnant because they were growing extraordinarily quickly through 2020 and 2021. They're not looking bad whatsoever. They are still going up. It's still happy days. But yeah, it's slowing down just a little bit. So vehicle sales were up 24.8% year over year, but the quarter over quarter numbers were not quite the same. Vehicle margin came down just a little bit, but you're going to see that with the large majority of these EV plays, okay? Total revenues increase of 24.2% from the year prior. We see gross profit representing a decrease of 6.9% from last year. Again, costs have gone up across the board. But again, just take a look at that balance sheet and it really, really is not bad. That's an NEO. Again, I personally do think at these price points, it is quite high risk. I'd still personally, be looking towards the 1650-ish mark to see if they can keep it up here, see if they can keep strength. If they consolidate above $22 though, I think that we could be in for a nice short-term upwards move. Long-term, again, who knows what's going to happen in the next 1, 2, 3 months. But yeah, that'll be the general price action I would expect going forward in the short term. Now we actually have a company that I personally have not bought since early 2020. we have Disney. And I mean, again, it's a crazy chart to behold. Generally speaking, Disney has been, upwards moving. Then there was some consolidation. Always had big upwards moves. And boom, 2020, we had that huge dip. This was the first time I bought Disney. We were picking them up under $100 a share. And what would you know? You can actually do that again more than 2 years later. So this is Disney. They need no introduction. Absolutely huge company. Again, we can see RSI is at extraordinarily oversold levels, ones that we haven't seen since 2022. And before that, I hadn't really seen since 2008. So I would expect Disney to make a nice little upward move soon. This may well be the one that I would have the most short-term conviction in, but don't take that as a buy because there is quite a few issues that have been going on. But when we do take a look at the quarterly report, we'll see that a lot of them have been somewhat fixed. Again, we're going to go have a look at the analyst breakdown. 16 strong buys, 6 buys, 7 holds. Again, we are seeing no sells. The consensus is there. Okay, you see the growth and profitability are looking very good. Momentum doesn't really matter for us long term. And then valuation isn't great. That's why I suppose a lot of people are still holding out on Disney. And I mean, they've been doing right. It's just gone down and down and down as the most companies have. That's why I haven't been buying for the last few months. We look at our balance sheet. And again, I'm just going to go to our current assets. We're at 13. Total assets. Now, these guys obviously have huge total assets at 74. They can cover their current liabilities pretty much 1-to-1 off of their current assets. And they can cover their total liabilities more than twice with their total assets. So again, in a good cash position, in a good asset to liability position. There is no real complaints there. So how is the company actually doing? Why have they been going down so much? Well, if you just take yourself back to 2020, rolly times, we're still in them, I suppose, just not to the same extent. They obviously had to shut down, all of their parks, etc., etc. And then they had to open up with, they couldn't, not full capacity, and then they introduced the likes of Disney Plus, they have Hulu, etc. And that's where a lot of their money started to come in from. And you'll see that if you spend a bit of time going through their latest quarterly report. So, revenues for the quarter and 6 months grew 23% and 29% respectively. Yep, despite a 1.0 billion reduction for the amount due to a customer to early terminate license agreements for film and television content, blah, blah, blah. They did well the last 3 and 6 months, yet boom, they are still going down in value very, very quickly. EPS increased to 89 cents from 52% the prior year, but diluted EPS from continuing operations decreased to 26 cents from 50%. So obviously I'm not going to bring you through the entirety of things here, but there's a couple of things I would like to point out. We have a look at Disney Media and Entertainment distribution, change of up 9%. Disney Parks Experience and Products up 100% year over year. So total segment revenues up 30% year over year. Fantastic. That is what you want to see, but it's also what we would have expected. We look at some of their paid subscribers from Disney Plus, ESPN Plus, and Hulu. They're direct to customers. All of them are going up hugely. They've done a very, very good job here. It's clear to see. One thing that happened recently, Disney brought out a game on June 23rd. Disney Mirrorverse was created by Kabam in partnership with Disney and Pixar Games. This has a lot of in-app purchases, which it's only a 7+ rated game. Quite a few people probably don't think this is right, but I mean, that is the way the world works right now. Microtransactions are everywhere on the App Store. And personally, if I was to be a Disney investor, this is something I will be happy to see. This is a huge market. And if this game becomes a very large game, there is going to be insane money added to that already impressive balance sheet, and it is going to make things look considerably better than they already do. So again, Disney still has a lot to do, and they have a lot of catching up to do. Rowley really did hit them hard, but they are a giant, and they are always going to have more ways to make more money as needed. Now, the fourth one I have for you is more than likely the highest risk one we have to speak about today. It is one I do, however, love, and that is ChargePoint. Now, I'm only going to go through this briefly. I made a full video on these guys a month or two ago explaining just why I really did love them. Down at these prices in particular, I bought more shares for the first time a while ago. Back here, we went up, we came all the way back down, really low. That would have been a great time to scoop up some more shares. But anyway, this is one literally on this channel we followed from day one. I invested here to start. It's obviously come all the way back down lower. But yeah, it's one we've been following from the beginning. And it's one that I really do like. Now, again, it's an EV charging company for the most part. That's what they look for. 20 analysts in the last 90 days. We've 11 strong buys, 3 buys, and 6 holds. So again, general consensus is that at these prices, or more so a little bit lower, is a good buy. And the rest of them think it's worth a hold. I want to point out something extraordinarily obvious though, guys. There is a huge downtrend here, okay? We are showing some strengths, but if we are to drop back below 1260, there is nothing to say we can't lose a further 40 to 50%. And that is just the reality of it in the short term. So again, definitely consider this a high risk play in the short term. But the long term, I don't think there's many better EV plays out there if you can get them at the right price. If they are to drop another 25, 30%, for example. Now, when it comes to the balance sheet, guys, this one's not going to impress you quite as much as the other ones will. But current assets, we have 712. Total assets, we're at 1, okay? Current liabilities, 212. They cover them over 3 times. Total liabilities, they have covered as well, okay? They're in a good position. As far as EV company goes in particular, they're in a good position. But where the good position really comes into play is the growth. Just look at the growth that has been happening. Even for these guys year over year when it comes to cash, short-term investments, etc. Receivables, current assets have been getting much better considering all of the growth that they're going in, okay? Quarterly revenue recently increased 102% year over year, reflecting momentum across all verticals. I mean, 100% year over year revenue increase. Happy days. Achieved record growth in Europe with 67% quarterly revenue growth. There is currently over 188,000 activated ports under management as of April 30th, 57,000 of which are in Europe. Fortifies the balance sheet with 300 million cash raised from convertible notes offering. So again, some people see this as a bad thing in the short term, but in the long term, it is undoubtedly a very good thing for the company. And they went ahead and confirmed full year revenue guidance of $450 to $500 million for 2023. What does the macroeconomic outlook hold for ChargePoint? Well, according to Bloomberg, EV sales will increase to 26 million units in 2030. This means ChargePoint and other charging infrastructure companies has to be reminded. ChargePoint does not have a monopoly by any means here. Could become big winners in the long run as more people embrace EVs. According to IEA, sales of electric cars, including fully electric and plug-in hybrids, doubled in 2021 to 6.6 million. I think we all know that the growth's there. I don't know how many videos I've made about the outlook for EV in the future and the growth that they have already seen. There is so much data out there pointing to this being literally inevitable. Electric car sales nearly tripled to 3.3 million in China, 2.3 million in Europe, and 630,000 in the United States. First quarter 2022, global electric car sales came to 2 million despite global supply chain challenges. I think everybody knows about these challenges, chips, etc. It would be reasonable to conclude that the long-term macroeconomic outlook facing ChargePoint is promising. And again, that goes for any EV charger and the large majority of EV companies. Earlier in the week, a ChargePoint block trade of over 1 million shares priced at $14.75, and D.A. Davidson maintained a buy rating and assigned a price target of $20 with a 27% upside, okay? The shares of ChargePoint Holdings have received a 24% price target from Everscore ISI. This is from June 8th. They adjusted the rating following the company's quarterly report, and West noted that ChargePoint has an advantage as a first mover in the rapidly growing EV charger market due to its scale, land, and expansion strategy, along with new software and hardware advancements. So we can see, new price targets coming in from companies in the upwards direction. It's a very promising thing to see. So that's ChargePoint. Again, if you want to watch the full video, my most up-to-date video on them, there's quite a few of them. I will have it here ready for you. Okay, and last company isn't actually a company, but we are just going to really briefly speak about bank stocks because I'm sure they are of interest to some of you. All 34 bank stocks in Federal Reserve stress test would weather severe recession. If you look at Wells Fargo, for example, you'll see they're down 31% from recent 2022 highs. They're down about 40% from highs back here in 2018. If you look at BOA, generally considered a little bit of a safer one, they're down 34% as well. And obviously there are many more banks to look at. But Federal Reserve stress tests showed that they would all weather a severe recession, which I believe is everybody's biggest fear right now, is this severe recession that could hit not just the US, but pretty much the entirety of the world. So all of the bank's test results remained above the minimum capital requirements, despite total projected losses of $612 billion. Banks, this is just a positive thing for everybody. Bank investors or not bank investors. For any investor, this is a positive thing. Under stress, the aggregate common equity capital ratio, which provides a cushion against losses, is projected to decline by 2.7 percentage points to a minimum of 9.7%, which is still more than double the minimum requirement. So it may be time to look at some of these bank stocks if you've been considering buying, even if you're looking to add them to one of your dividend portfolios. And briefly, investors retracted $20 billion in fund assets last week, led lower by market tracking ETFs, okay? The financial community was overall net redeemers of fund assets as investors retracted $20 billion of funds from the market, including both conventional funds and exchange-traded funds. What I want to do is this. The stock market could surge 7% next week as quarter-end rebalancing drives buying spree for equities, JP Morgan says. Now, again, this is by no means a guarantee whatsoever. I'm not calling the market running up 7%, but it's an interesting one. JP Morgan highlighted that while rebalancing trades are usually not the main driver of the stock market, they can have an outsized impact when stocks see big moves in the same direction. The rebalancing trades can also have an outsized impact on the stock market when liquidity is low, which is the case today, according to JP Morgan. Taking into account the current market liquidity, as measured by future market state, it's about 5 times lower than the historical average. So this may well lead to some upward momentum this week. We're going to have to wait and see. But guys, there are my 5 stocks, or more so 4 stocks and 1 general industry for you guys to go do some of your own research on, that I think are at interesting levels, if nothing else. Again, I want to make sure everybody is aware that nothing in this video is financial advice, first of all, quite obviously, but also that the macroeconomic outlook of the world is still not in the best place. There are some things getting better and some things still getting considerably worse to this day. Keep that in mind. Me personally, I'm still not investing particularly heavily, but that is partially due to the fact that I'm trying to get moved into my house relatively soon. I know that's going to take up quite a few of my free funds. But yeah, we're still going to take a look for some juicy deals. Anyway, guys, if you watched this video all the way till the end, I would just like to thank you so much. I would like to say that you, my friend, are a true legend, and I'd appreciate if you hit that juicy like button and drop me a comment down below. Anyway, guys, I hope you all have a beautiful, blessed day. I'm going to see you for another video very soon. Peace.